All right, so Prateek Agarwal of Motilal Oswal PMS is joining us now. Prateek, afternoon, good to see you with the big smile on your face. You were telling us offline that you are
Motilal Oswal
beneficiary.
AMC.
AMC, of course, yes, but the PMS is a part of AMC, right? A very large and meaningful part, I would say, which is reflected in your numbers as well. But I like the smile on your face, beneficiary of both the valuation going higher and good flows. Does it appear structural, the flows part at least?
Oh yeah, that is something we have been covering over, I think, every video that we have done from this house, which gets released into the market first of every month. See, our thought is for the same reason that people are able to buy cars and ACs is the reason that people can come into the equity market. It is basically that they have more money, the per capita are increasing. When that happens from a nation of savers, you become nation of investors. You have the ability to take risk of uncertainty and be in the equity market. So I think with the transition that we are seeing on the per capita levels in the country, this is a very structural thing which is happening. It has been happening for now 3-4 years. I think this is just the beginning. It will continue till the India story continues, which is the demographic dividend.
Okay, one part of the market, sure, I get it, I get your point. And in fact, the entire AMC, mutual fund distributors, market participants, some brokerages, and even the technology-led, backdrop service providers, all of them got re-rated last few months. But one sector, which is the envy of many, just because of the sheer missed out feeling it gives, is the PSU basket. It got massively re-rated, but now the large part of that did not participate was energy, OMCs, upstream, that is getting re-rated. Do you see further scope for improvement in your kind of valuations there, or you think they are fully baked in now?
See, OMCs are, if you believe in, let's say, green energy, okay, then one would tend to see OMCs as end of life cycle businesses. And hence businesses where very small terminal value will be accorded. Now, does that warrant a 2, 3, 4 T? Probably not, because that end of life cycle is also several years away. But this is a space where one has to ask the question: what happens if the stock price drops 10%? What happens if it drops for some reason 15%? What confidence do you have of it coming back? Because growth in volumes processed, sales, etc. is just going to be 7-8% over next few years, and after that will probably taper down even more. So these are those kind of businesses, very deep in value, maybe end of life cycle, maybe they have 10-15 years more to go, but low on growth versus the economic growth rate, low on earnings growth once you normalize earnings versus the index itself. So as a value play, one can look at it, but with the caveats that I shared.
Prateek, just wanted to understand what's been the learning on what to invest and what not to invest in with this entire Paytm episode. I mean, still got sellers in the system. The stock opens and straight away lower circuit for the last 2 days.
Yeah, so the biggest lesson is, high on innovation companies should not dabble into businesses with very, very strong regulatory oversight. The two don't go together.
With high, return comes high risk as well, so need to kind of keep that on board. But Prateek, what's your sense on the private banking space? When earnings were good as well, the stocks weren't moving that much, and now the earnings growth has started tapering off a bit. What should one do with respect to the private banks? Add for a long-term portfolio, or wait for better entry levels?
No, so let us look at it this way. Banks, lenders accounted for over 35% of an index. That is as high as it gets. 37, 38. They accounted for 40% of growth of earnings in the marketplace. Does one believe it can get better? It is almost like in the listed space, close to 40% of the profits were done by banks. Everybody else put together makes 60%. Now, this is something which structurally is not sustainable. People are doing other enterprises with a profit motive. It should add up to more or much more significant part of total. So small point is as a part of total profit pool, while banks will grow, maybe they will account for a smaller market share of profits, which then means they should account for smaller market share of index, which also would then point to smaller market share of a portfolio of guys who want to be close to the index. So that is one thought. The fact that we are looking at interest rates coming off over the next 5-6 months, and it is a very good possibility given the way fiscal consolidation has been the focus in the budget table yesterday. Drop in interest rates are not very good for NIMs of the banks, which again is an issue that has to be tackled. So as a house, frankly, we have been underweighted banks significantly versus the index over last 1 year.
About financials, public sector, but which are the other areas that you would, suggest people to book profit out of? Railways, defense. We were looking a lot more overheated. Real estate, for that matter, has started seeing a bit of a derating cycle, at least from the brokerage houses. Any specific pockets where you think over exuberance is there?
No, so when markets are at a high, obviously there will be many pockets where there will be over exuberance. There is over exuberance in all ownership classes, private and public, MNCs and Indian or professionally run. So at the stage of the market we are in, that is there to be there. My whole thought is some bit of it is extreme and may result in larger losses, but most of it is not extreme. Okay, and for traders, maybe it makes sense to sell and try and buy it lower and all of that. But one simple thought that I have is this is the period where the spaces which are doing well may have some mirroring in what did well in the 2000 to 2007 kind of a period. Where again gross fixed capital formation, for example, expanded as a part of the GDP. We are again beginning to see that for last 2 years. Typically, it is not a 2-year thing; it is a multi-year thing. So we have probably seen 2 years out of 7-8 years of that cycle. So I think the same spaces which did well over 2 years could continue to do so on the growth side. This period is not like 2008 to 21, where growth in EPS of the index, the large cap index, was just 5.1%. This is more like 2000 to 2008 kind of a period where growth in index earnings was mid-20s kind of stuff, and these mid caps grew earnings faster than large, and these small caps grew earnings faster than mid. So it is that kind of a period. So I think one should look at that period, try and gain knowledge from there. Maybe the success rate would be higher.
On that note, we let you go. Thanks so much for making time and speaking with us. But for the markets, we have taken a turn for the worse, and take a look at the Bank Nifty as well. That's seen a cut of almost 800 points from the highs of the day, and that index is now in the red. At one point of time, it was actually outperforming the frontline index, but that has turned now. Axis Bank, HDFC Bank, Federal Bank, IDFC First, these are some of your top losers. So it's the private sector banks yet again which are coming under pressure. Time for a quick break. Don't go anywhere.